So now let us start with Essay 265, Communication of Deficiencies in Internal Control to TCWG and Management. So this standard mainly deals with communicating whatever deficiencies in internal control that the auditor has identified to TCWG and Management. So in order to understand this essay in a better way, first and foremost, let us sort of visually categorize our components in this essay. First and foremost, whatever deficiency is there, let us take this little clown over here as the deficiency, okay, because this will help you to get through the entire essay and remember all the points. So if you have watched the movie It, then you will easily be able to understand this. Even if you didn't watch the movie, just remember that the clown over here, so this clown or this ghost or whatever you want to think, so this is the main deficiency over here, okay. So this is a deficiency. Then in that particular movie there are little kids, so the ghost goes behind these kids and troubles them, it sort of scares them. So these kids are our financial statement amounts, okay. And the ghost has different forms, so it can be in the form of like a housefly, or it can be in the form of like a snail. So these are other deficiencies in internal control that somehow look like the same main deficiency, but they're different, okay. So their form will differ. So keeping this thing in mind, let us start understanding this particular standard. So in this particular standard, the auditor's responsibility is to communicate to TCWG and management. TCWG is the top level authority. So TCWG is responsible for the oversight of the financial reporting process. So the auditor, whatever deficiencies that he has identified in internal control during the audit, he will communicate it to TCWG and management. That is the auditor's responsibility in this particular essay. Now, what is the objective? Objective is also the same thing. You're communicating to TCWG and management about deficiencies in internal control, but those kind of deficiencies that have sufficient importance to merit their attention, okay? Very, very significant deficiencies that are very, very important. Auditors, so the management and TCWG should, give their attention to such kind of deficiencies and should rectify, okay? So, what is deficiency in internal control? When does it exist? First, controls that are designed, implemented, and operated, which are unable to prevent, detect, and correct misstatements in the financial statements on a timely basis. Those are deficiencies in internal control. Or controls that are supposed to prevent, detect, and correct fraud in the prevent, detect, and correct misstatements in the financial statements. If they are missing, then also there is a deficiency in the internal control. So when does the deficiency exist? When the controls which are designed, implemented, and operated are unable to prevent, detect, and correct misstatements in the financial statements on a timely basis. So timely basis is very important over here. Next, whatever controls which are supposed to PDC a misstatement in the financial statements, they are missing. They are not there only, okay. Either you have implemented some controls and they're not able to do that, or the controls are altogether missing. In both cases, there is a deficiency in internal control. Now, when is the deficiency said to be a significant deficiency in internal control? So significant deficiency is a deficiency or a combination of deficiency in the internal control. See, deficiency is the main clown or the main monster. Combination of deficiencies are its different forms. Okay, so deficiency or combination of deficiency in the internal control, which in the auditor's professional judgment is of sufficient importance to merit the attention of TCWG and management. So TCWG and management are the parents of the kids, and this ghost is bothering them. So it is a very, very important to get to their attention that the kids are affected by this. They are not able to go to school fearlessly. They're not able to carry on their daily operations. So this deficiency or a combination of deficiency in the internal control, which in the auditor's professional judgment is of sufficient importance to merit the attention of their parents, that is TCWG and management. So the significance, okay, we know that it is a deficiency. It can be one deficiency or a combination of deficiency in internal control, which in the auditor's professional judgment is of sufficient importance to merit the attention of TCWG and management. But their significance, on what does their significance depend on? So their significance depends on actual misstatement, likelihood of occurrence of misstatement, and potential magnitude of misstatement. Whether it has actually occurred, or whether there is a high likelihood of occurrence of that misstatement, or there is a potential magnitude. So the magnitude of the misstatement is very high. Then see, on these three factors the significance depends, okay. And a misstatement, a deficiency, A deficiency in internal control exists even if auditor didn't identify any during the audit. Even if you didn't identify any significant deficiency or any deficiency in the internal control, it doesn't mean that the deficiency doesn't exist. Okay, just like how there is God, there is evil as well. So the deficiency will definitely be there even if you didn't identify any during the audit. Okay, so examples of matter which in the auditor's professional judgment, which the auditor may consider necessary to determine whether deficiency or combination of deficiencies is significant. So we know that deficiency will be there. How to check whether it is a significant deficiency or not? So here are a few examples, okay, in which the deficiency is considered as significant deficiency. First thing, there is a high chance that the likelihood of deficiencies leading to misstatement in the future. Right now, there is nothing going wrong. But because of the deficiency, a misstatement may happen in the future in the financial statements. So there is a likelihood of deficiencies leading to misstatement in the financial statements in the future. Second, susceptibility to loss or fraud of the related asset or liability. So because of the deficiency in the internal control, your asset is susceptible to loss or fraud in the future. Okay, so susceptibility to loss or fraud of the related asset or liability. Next, subjectivity and complexity in determining estimated amounts. So because of the deficiency in the internal control, you are not able to determine your estimated amounts. It is becoming complex for you. So there is subjectivity and complexity in determining estimated amounts. So here one example is over here, fair value accounting estimates, which you can remember. Okay, next, so this thing is important. See, financial statement amounts exposed to deficiencies, then analyze the impact of deficiency on financial statement amounts. So these are the financial statement amounts I told you in the beginning of the video. So these are exposed to deficiency, then analyze the impact of the deficiency on the financial statement amounts. So if you look in this movie, because of the fear of ghosts, they don't feel like going to school, they are always scared, all of that. So financial statement amounts exposed to deficiencies, then analyze the impact of deficiency on financial statement amounts. So what is the impact? Okay, because all kids are not courageous, some are scared and some are brave. Okay, next, volume of activity. So volume of activity that occurred or could occur in account balance or class of transaction which is exposed to deficiency. So this account balance and class of transactions, these account balances and class of transactions are exposed to deficiency. Then whatever volume of activity that has occurred in these or could occur in these, whether it is exposed to deficiency or not. Okay, that is the main idea. If you read the text as a whole, you'll understand it. Next, importance of controls to financial reporting process. So the controls over general monitoring, prevention, detection and correction of fraud, selection and application of significant accounting policies, significant transactions with related parties and significant transactions outside normal course of business, period end financial reporting process. So whatever controls are there, see, controls are very, very important over your financial reporting process. So whatever controls are there towards your general monitoring, towards your PDC of fraud, towards selection and application of significant accounting policies, significant transactions with related parties and outside normal course of business, period and financial reporting process. So whatever controls are implemented, are they proper or not? Whether there is any deficiency in the controls implemented. So that is all that you need to write over here. Importance of controls to financial reporting process. Next, the deficiency in the control. See, first and foremost, the cause and frequency of exceptions detected because of deficiency in the controls. Because of the deficiency in the controls, you are finding out some exceptions. Normally, it won't be there. But because of the deficiency in control, some exceptions are detected. What is the cause and frequency of those exceptions? Cause and frequency of the exceptions detected due to deficiency in the controls. Next thing, interactions of the deficiency with other deficiencies in internal control. That's it. So this part is done. Examples of matters which the auditor may consider necessary to determine whether it's significant or not. Next, identification of deficiencies in internal control. So the auditor performs audit work. He identifies deficiency or combination of deficiencies in internal control. Are they significant or not? You perform your audit work. You identify some deficiency or a combination of deficiencies in internal control. Are they significant or not? How will you determine? What are the indicators of significant deficiency in internal control? So the first thing is evidence of ineffective IC. So internal control is ineffective. What is the evidence? If you're doing transaction scrutiny, there is lack of governance oversight on significant management involved transactions. So who is responsible for oversight? Who is responsible for oversight? TCWG. TCWG is supposed to oversee the financial reporting process. Who is supposed to prepare the financial statements? Management. So here TCWG is not overseeing. It is not governing. So there is lack of governance oversight on significant management involved transactions. So there is an evidence of ineffective internal control. Next, management fraud. So whatever management fraud is being going on, it is not prevented by internal control. Then there is the evidence of ineffective IC. Next, remedial actions. Management's inaction to previously identified significant deficiencies. So there are some significant deficiencies which the management only identified them, but they are not taking any action. They're just sitting like that. They are being inactive. So management's inaction to previously identified significant deficiencies. So it's not taking any remedial actions. Then also it means that there is ineffective internal control. Next, control environment. So control environment is nothing but your internal control only. So signs of ineffective components within the control environment. So there are a few components within the control environment which are ineffective, because of which the entire control environment is functioning ineffectively. So signs of ineffective components within the control environment. Next, we have 3 points which are very, very easy. Risk identification, risk assessment, and risk response. So ineffective entity risk assessment process shown by this is a typo over here. Okay, you can ignore this point. Just understand that risk identification, risk assessment, risk response. So if you're not able to identify your risk, then you'll not be able to assess your risk, and ultimately you'll not be able to respond to the risk. If you have identified your risk but you're not assessing, then you'll not be able to respond. If you've identified the risk, you've assessed the risk but you're not responding to it, in either case there is ineffective IC. Next, management oversight. So management's inability to oversee the financial statement preparation. Okay, so they are not able to prepare the financial statements. They are not taking, they are not monitoring their subordinates in the process of preparation of financial statements, and TCWG is not overseeing them. So all of that. Misstatements not found by internal control. So there are a few misstatements which the internal control is not able to detect. Statements which are found by auditor, misstatements which are found by auditor are not caught or corrected by internal control. So indicators is done. So indicators mean, you just remember this thing. 3 points are very, very identical, very, very connected. Risk identification, risk assessment, risk response. The next points are, management is not able to prepare. Management is not overseeing the preparation of financial statements. TCWG is not overseeing the management. This point and this point, transaction scrutiny. Misstatements are not found by internal control. Management fraud is not prevented by internal control. Next, there is management's inaction to previously identified significant deficiencies. It has identified significant deficiencies, but it's not taking any action. Next, communication of significant deficiency in internal control. So what is the job? Auditor's job is to communicate significant deficiency in internal control to TCWG and management. So the auditor has to communicate significant deficiencies in internal control to TCWG in writing and on a timely basis. Same thing for management as well. But to management, he has to communicate significant deficiencies in internal control and also other deficiencies in internal control in writing, timely basis, to appropriate level of responsibility. Okay, so in management there are different levels of responsibility, right? TCWG is only one, it's a top level, but in management there are different levels of responsibility. So to the appropriate level of responsibility, you communicate significant deficiency in internal control and also other deficiency in internal control in writing and on a timely basis. But remember, when can you not communicate significant deficiency in internal control to management? Unless it would be inappropriate to communicate directly to management before communicating to TCWG. It means that you should first communicate to TCWG and then communicate to management. Okay, if you're not doing this way, it would be inappropriate. Such a kind of deficiency, you cannot communicate to management before communicating it to TCWG. Next, other deficiency in internal control. So what is this other deficiency? So other deficiency is basically a deficiency which is not communicated by other personnel. And the auditor, in the auditor's professional judgment, it is of sufficient importance to merit the attention of management. That other person has not communicated this deficiency, but auditor thinks that this is very, very important. It needs to merit the attention of TCWG and management. It should be communicated. So that's the reason auditor will also communicate other deficiency internal control, which he thinks are of sufficient importance to merit the attention of management. So once you have communicated, see, you should communicate in writing. Okay. So what you need to include? First and foremost, you give description. You give description of the deficiency and explain its potential effects. Because of the deficiency, what are the effects? What effect will the internal control have? What effect will the deficiency in internal control have on the entity? And also give suggestions to improve the deficiency. First thing, give description. Second thing, explain the potential effects and also give suggestions to improve the deficiency. Now, the auditor should give sufficient information that will enable TCWG and management to understand the context of communication. See, TCWG and management, sometimes they may not understand exact audit terms. Okay, so you should communicate to them and also give them sufficient information that will make them understand the context of the communication. Okay, next thing, the auditor will further explain. He will explain the three things: purpose, internal control considered, and deficiency. So first thing that he will explain is that the audit purpose is to express an opinion on the financial statements. The second thing that he will say that the audit has considered, while doing the audit, you have considered the internal control that is relevant for the preparation of financial statements and relevant for designing the audit procedures. You have considered the internal control, but you do not express opinion on internal control. Okay, and the matters reported herein. First thing, purpose. Second thing, that you have considered internal control. Third thing is that you will give description of the, you will say that the matters reported herein are limited to deficiency, especially the deficiencies identified during the audit and the deficiency which is of sufficient importance to merit the attention of TCWG. Okay, three things: purpose, internal control considered, and matters reported herein are limited to the deficiency that you have identified during the audit and they are of sufficient importance. That's it. We are done with essay 265.